So here we are, investing in a new dream for a new India. Let's then open the house with the first panel of the day, India, $100 billion PE VC market. Well, PE VC investors poured in over $70 billion into Indian companies in the year 2021, a number that was unimaginable 5 years ago. The growing size of the PE VC market has meant that more global investors are waking up and waking up to the potential that India offers, and the pace of dollar inflows into India will only keep increasing. India is definitely on the cusp of becoming a $100 billion investment market. I'd like to invite on stage the speakers of this session, Nikhil Srivastava, Partner and Managing Director, Head of India Private Equity, PAG. Good morning, Nikhil. Aye. Sudhir Variyar, Managing Director and Deputy CEO, Multiples Alternate Asset Management Private Limited. Taaliyan ho jaye hamare speakers ke, ladies and gentlemen, please. Neha Grover, South Asia Lead PE Funds, Disruptive Technologies and Private Equity Funds, International Finance Corporation. Good morning, Neha, and welcome. Sajid Fazalboy, Partner Iron Pillar. Please join me on stage, sir. Good morning. Harsh Payas, Partner Tri-Legal. Good morning, sir. Very warm welcome. Amit Jain, Managing Director and Co-Head, Carlyle India Advisors. Good morning and a very warm welcome to you. And of course, I must invite on stage the moderator of this first panel of the day, Dinesh Tiwari, Managing Director, Broad Peak Capital Advisors, LLP. Good morning, sir. And it's over to you.
Thank you very much, and that was a very enlivening beginning to the day. I think to start with, it's great to be here, to be with the exciting panel, and essentially discussing a topic which is of strong relevance here. You can't open the newspaper today without reading something about either a new deal or a new fund that has come up, or even a new unicorn. I mean, earlier unicorns were actually quite rare, but I mean, today we've got over 80 of them, at least in the last count that was in place there. So these are clearly very exciting times there. And to discuss that, we have with us a fairly rich and diverse panel of people who have a very strong and rich experience of investing both in India and overseas. Let me begin by introducing the panel to you, and then maybe we can open up the questions in terms of a question and answer format. We'll try and take questions towards the end if we do have time, but we will sort of try and work towards that. I'd like to introduce Neha. Neha has been the South Asia lead for private equity funds and disruptive technologies at the IFC. She brings with her a very strong and rich experience of investing. Prior to her current role, she was with Baring Private Equity and has invested in a large number of businesses. In her current role, she basically has a global perspective of the Indian private equity industry. She is on the advisory board of several private equity funds there. She essentially is a chartered accountant, a company secretary, and graduate from the Indian Institute of Management, Lucknow. Happy to have you here with us.
Thank you. Thank you. It's a pleasure to be here.
Thank you. Next, we have Sajid. Sajid is a partner at Iron Pillar, which is a growth stage VC fund. Iron Pillar primarily invests in Series B, C, and D businesses there, largely in new age and technology businesses. As we have seen, the technology space has actually been getting significant interest from investors in the recent past and accounts for a significant part of the Indian private equity ecosystem. Prior to this role, he was an entrepreneur. He was basically the founder of a software services business and essentially been an investor for almost a decade with Bloom Ventures and has seen a number of investments. Next to him, we have Amit. Amit is the MD and co-head of Carlyle India. He brings with him a very strong, rich and strong investing experience of over a decade. Prior to his current role, he was with Blackstone as a senior managing director and has worked with McKinsey and Unilever and a graduate of the Indian School of Business there. Carlyle, as you all know, is basically one of the largest investors in the country. I may be off in terms of numbers, but clearly we invested about $5.5 billion in over 40 odd businesses over the years. Next to him is Nikhil Srivastava. Nikhil is a partner and managing director of PAG, which is one of Asia's largest alternative asset managers there. They manage about $45 billion of AUM and are currently investing out of a $6 billion fund. They have essentially done a number of large marquee transactions. I'm not too sure from a privacy perspective whether I'm expected to name them, but clearly they've done a large number of transactions, and some of those are pretty well known to most of us here. Next to him is Harsh. Harsh is a partner with Trilegal and the co-head of the private equity private practice. He's seen a number of private equity transactions and essentially been a party to a number of transactions that have taken place in the industry. He brings with him a rich experience of advising private equity funds and companies in the industry. Next to him is Sudhir. Sudhir is an ex-colleague, and he is essentially he's the managing director and deputy CEO of Multiples. Multiples is one of India's largest homegrown private equity funds that has come up in the recent past. Prior to this, he was with ICICI Venture, a long stint at ICICI Venture and Fitch and ICICI. And essentially, he's a graduate from IIT Varanasi and IIM Calcutta. Welcome all of you to the panel, and it's great to have you here. Yeah. Let me begin by first asking maybe Neha, if you could give in your perspective at a global, you see India from a global perspective. And when you see the market, I mean, what's relatively, how does India position, what's the relative perspective? Where does it fit into the rankings? How does the external world look at India?
Hi, can you hear me? Great, thank you. Thank you, it's a pleasure to be here. So IFC, just to give a quick background, IFC is a large emerging market focused investor into private companies. We deploy about $20 billion globally, $2 billion into India on an average every year. And private equity funds is a focus area for us. We've been investing in India for the last 50 odd years. So we've seen India evolve. We've seen India sort of going through its ups and downs as all countries do. If you look at the recent few years, I think given the geopolitical dynamics and where India is in a structural growth cycle, we see that India is an investment destination of choice. Of course, IFC is not like most other commercial investors. We're a developmental financial institution and therefore focus on cycles and markets and segments in markets when many people are not looking at it. We've been, for example, we've seen the microfinance cycle, we've seen a lot more cycles. And we've developed those sort of markets as well. I think if you take a step back and I were to look at India on a relative basis, India is definitely an investment destination of choice today. Within emerging markets, India is one of the more stable, structurally sound countries where there are a lot of positives, like we have the demographic dividend, we have a stable government, we've had our ups and downs, but I think in terms of the facilities, the infrastructure, we've seen a large sort of increase in that as well. There are certain sort of caveats, there are issues. I think if we see a stable government and policy and regulation, I think India is going to continue to be one of the shining stars in any portfolio for a global investor.
And how do you see this, the acceleration that has been there in the recent past? I mean, if you were to attribute some reasons for that, what do you think it would be?
I think if you look at it, you'll have to take a step back to about 10 years ago or 15 years ago, the global financial crisis. That's when people were looking for growth, and there were very few countries which had a democratic government in place where investors were sort of cautious but willing to invest in. And so that's one. We've had a long history of that. I think post 2014-15, after the government has changed, we've seen pro-reform, we've seen regulation changes, a lot more investor-friendly regulations coming in as well. So that's one. And I think the whole relative scenario, right? Within emerging markets, you've got foreign currency has been stable. We've got reserves today which have kept the rupee depreciation to a bare minimum. I think all of these things add up.
Sudhir, if I can ask you to step in here, I mean, as essentially you see a lot more LPs in terms of the domestic fundraise, and when you actually talk to investors and you talk to LPs globally, I mean, what is it that they talk about? I mean, why does India tick?
So Dinesh, as we all know, finally capital chases growth, and the fact that this is one of the fastest growing economy. But I would still say that even now, despite all the numbers that we hear about $70 billion and so on and so forth, I would still say that we are not part of the capital allocation of all the global pensions, in the sense that we may be clubbed together with some emerging market exposure or some higher potential. But I think for a country of our size, eventually we need to get into, we will eventually get into a position where we get into that global allocation. And when I still meet a lot of investors, there is still that little bit of that India selling which needs to get done about the trajectory that we are on. Questions like the currency depreciation, which I would have thought that with 20, 30 years of track record of saying that we kind of, over long periods of time, you can prove that currency depreciations have been in the range of about 3 to 4%. It never goes berserk. These are questions which still come about. Questions like exits in the Indian market and stuff. This is despite players like Carlyle and PAG, etc., all present here who have done, some of them have been there for several years, have done many exits, but even then these questions still remain. So I would still think that there are a lot of investors who understand the India potential have come in, who does large deals, multi-billion-dollar deals in the current Indian market. But I would still say that there is a lot of investors out there who have not yet, to that extent, to answer your question in terms of selling to LPs, where there is still a selling required. And I think, and which is what gives us the confidence that even $100 billion or $200 billion, these are all numbers that we will hit at some point in time as we get into the real country-specific allocation for India. Like, for example, I would think that there is an allocation for China already in many of these pension funds. Similarly, India will get there at some point.
Right. And I think interesting you talked about exits, right? And I think if you look at the recent IVCA report in 2021, there has been almost about $43 billion in terms of exits. I mean, if you were to go back earlier in previous conferences, say before 2015, lack of exits was always a strong topic for discussion. Are you saying, is that still a topic for discussion, or have investors or LPs moved on to essentially, with all these strong exits, for example, a Flipkart exit or the last year's $43 billion of exits, has that essentially helped assuage that fear?
So Dinesh, what I was meant, there will be a lot of investors who know India well and who kind of cross that hump and they see that there is enough exits that have happened in the last 5 years, but you still find a lot of investors with very limited knowledge of India, for whom still the question is, what are the ways of exit, how do you exit, transactions, and so on. And there is still that education that gets to be done. But the fact is now that you have statistics to back you. About 5-6 years back, you were saying, based on a hunch, the size of the economy, the fact that there are multiple ways of exit, that we have a fairly mature capital market, all of these were still a little bit more of hypothesis that you would be showing. Today you have exits of several large IPOs, several large strategic transactions, PE to PE transactions that have happened. So you have a lot of data on your hand, but still you need to kind of cross the hump. And the last point I would say is the last 10 years have been, despite the fact that we have been a growing market, returns that have been made by LPs in the developed part of the world has been very attractive. So all of that also, why should I make this extra effort of reaching out to countries like India still remains. So with many of the LPs, when you are doing all your road shows and meeting people, there is still that bit of India selling that comes in. But I'm fairly confident that these things kind of ease out, and we are very well on the trajectory to say that we will be a very important investment destination going forward. There are so many factors. The last 10 years have not been easy, right? In the sense that the growth has been, while we have companies which have grown, the economy has not really grown to its full potential. We had bank balance sheets, we had corporate balance sheet that was stretched. Suddenly you find yourself in a spot where a lot of these have been resolved. There is a huge confidence among the entrepreneurial system. The way we handled COVID, the way we have put in place the payment infrastructure, all of that, the technology, companies kind of evolving. So there is a huge confidence both
the last 7 or 8 years. And that, I think, is still a problem for global LPs, especially, so there are two kinds of LPs. LPs who invested in the earlier cycle in the mid-2000s and have never seen money returned to them. I think they are still not happy because most of those funds are still sitting on unrealized assets, written down assets, and people are stuck. Then there are LPs who are starting to look at India now. And as Sudhir mentioned, I think within global market, within global portfolios, emerging market allocation is, let's say, 1 or 2%. Within that, China used to be capturing 50 to 60% of that allocation, and all other countries put together globally were in emerging markets were the rest of the world, right? And India still doesn't have that single country destination, but with numbers going up, with the check sizes going up, some super exits, entrepreneurs, sort of companies growing and becoming larger, unicorns becoming, I think India is now coming onto the map, and we'll see more exits, and that entire virtuous cycle is now set up, where VCs are finding exits to mid-market Ps, and mid-market Ps are selling to larger PE fund players, and larger PE fund players are able to exit through IPOs and strategic exits. And now that virtuous cycle, I think, is beginning, and hopefully this is just, sort of only set to grow.
I don't want to drag the topic, but I think the short point I would make is I probably carry a little bit more optimistic view than Sudhir. I personally think in the last 3 years, whether you call it the inflection point or people who are fan of physics, the escape velocity to get into a different orbit, I do think India has got into a different orbit when it comes to private equities. You've got $1 billion trade. You know, if you think about exits, you've got public markets which are buoyant, it's deep. You got sponsor to sponsor trade happening. You know, one fund selling to another, which was 5-7 years back considered, there's almost like a stigma around it, right? And it's a very deep market today where big funds are transacting at the PE level. Forget VCs selling to private equity. And finally, I would say the financing markets, and there is now a technology around dividend recaps, especially if you are a controlling shareholder. So with all forms, getting capital out There's proven technology at scale. So I do think, I think on exits, yes, there are always some funds, which is by the way there in the US also, and that's why this is a very tough industry to be. But at an average or at a median, I do think India is broken off that issue.
Thanks. So are you saying, Amit, that the Indian private equity industry is actually matured? So there was a lot of mistakes, as what Neha mentioned, in mid-2005, mid-2000s. You had a number of investors which basically made investments that shouldn't have been made in the first place. And managers have matured, and hence as a result of it, the newer investments that are taking place are actually seeing exits, where there's a lot of old dead wood which is still lying in the system. Is that?
Yeah, I mean, there are various ways to kind of to nuance it. There is no doubt about it. I mean, I often say that we are probably, if you take early 2000s as the years when industry started, kind of the teen years are over and we are in the adult years of private equity in the country, right? And to that extent, definitely we are mature, right? The other manifestation of the maturity, and which probably is a topic which is close to our hearts, where I sit in, is buyouts, right? If you think about buyouts, they're now 2/3 of the market, right, in terms of the dollar deployed in the last few years, and the trend is likely to stay. You see a lot of supply coming in on buyouts, whether it's MNCs divesting, whether it's kind of families asking themselves what's core to me, what's non-core, sponsor to sponsor trade, generational changes, all of it. So there's enough supply. But I think more importantly, and to your point on private equities maturing, if you think about funds being here for a decade or more, funds have built muscle, and this just as one or two. There are a number of funds which have now built muscle to run, operate as a controlling shareholder, right? That's internal through our operating advisors, operating teams. But the one fundamental change which is often not noticed, and I'll pause after this comment, is the way management talent in India has taken up to private equity. I think that is one change which is probably, I would say, underappreciated, but it's the fundamental change which is likely to drive the growth of buyouts going forward and the sustainability of private equity. Because if you step back, I mean, I often tell my team, we either are looking for owners who operate like professional managers, or we are looking for professional managers who are looking like owners, because those tend to be great deals, right? So if you're in a minority shareholder construct with an owner who works like professional manager, great, you got a great partner, right? Or else you're really looking for a class A CEO, on the basis of his or her conviction, you go out and deploy capital. And I think the fact that the top talent in the country wants to work, and we are kind of suitors for, we're able to attract as an industry, that talent is now kicking off this virtuous cycle. People want to work for us or the industry, and on the back of their conviction, we are able to underwrite a different view of the future than the last 5 years, and that's feeding off to our returns, and that cycle is just going on. So I think that's one fundamental trend, and that to me is the biggest symbol of private equity being matured in the country.
Absolutely, and I think buyouts and majority-owned transactions is something that we should talk about a bit more in detail. But I think before I get to that, just want to invite Nikhil, and I mean, you are relatively the more recent fund that has entered the Indian market, right? And I think if you were to just talk a bit about what has prompted that and what has been your learnings.
So I would say one of the things that motivated us to enter India market is really the fact that there's maturation of the Indian PE industry. And by that, what I mean is we are moving towards, as Amit was saying, more buyout transaction. And that sort of is to answer your question as well, like why buyouts, why is it so important? I think as you think about the number of transactions going up and the dollar deployed per transaction going up, one of the things as a PE investor you need to have to build conviction is the ability to control your destiny. And what a buyout transaction in a way allows you to do is basically have control on the value creation through the period of ownership. And the second part, which we were talking about a little bit earlier, was exits. So vast majority of minority investments that were made historically, people struggled with exits because the optionality, the number of avenues for you to exit were limited. You were at the mercy of the promoter in some ways. But as a controlling shareholder, as a PE player, you now can explore more options and maximize and optimize the process to maximize the value of the asset. So I think that was one part of it. I think second, as Amit also alluded to, is the supply of these assets is actually a part of the maturation where you're getting a lot more assets, be it spin-off by non-core assets by conglomerates. You have corporate in stress looking to divest asset to sort of pay down debt. And then you have promoters who are okay with now partnering with PE firms as minority to drive value alongside the PE firms, right? So the supply has expanded. And then the last thing that I would say, again, to sort of build on what Amit said, is the availability of talent. And I would divide that into two parts. One is talent availability, and the other part is talent mobility. So talent availability, if you look at the sectors where buyouts have primarily happened, are healthcare services, pharma, financial services, tech-enabled services. And there, the depth and quality of management teams is very, very high. And therefore, the availability is plenty. Then the question becomes, why is talent mobility important? Because for the longest time, there was high-quality talent, but they didn't want to move to a PE shop. But in the last few years, what you've seen is a lot of management teams have really done well in a buyout situation, right? When the PE owner exits, they have had a pretty significant wealth creation opportunity. And similarly, you've seen VC-backed companies where a lot of professional management teams have made a lot of money. And so that then has incentivized a lot of people who were on the sidelines in terms of high-quality management teams are now exploring opportunities with buyout funds to say, okay, I want to be part of it. So I think it's all of those things coming together, which has allowed us to effectively participate in this market and be excited about it.
So would you say that a large part of the market would actually grow to be a more buyout or a majority investor-owned market in India? So if you were to sort of crystal gaze, would you say that the market, the larger proportion of the Indian market would be a majority investor-owned market?
Yes. So maybe I would divide the answer into two parts. I think one is volume and one is dollars. When you look at volume, probably it'll be a little bit more balanced. You would have a lot more minority investment because the check size is small. But when you look at the dollar invested, I think you will see vast majority of them actually being buyout because the average ticket size per transaction is quite high. In fact, prior to this, we were having a chat and Amit mentioned, like you do one transaction like Hexaware, that's a large ticket size. And that will disproportionately impact in terms of the dollar deployed. So you will, at least I would expect more buyout and more capital being deployed in buyout type situations.
So, Sajid, if I can bring you here, right, I think clearly you are essentially a growth investor. And I think primarily, as we all sort of won in the private equity space, we said that we were actually backing entrepreneurs. And that was the key exercise. Right.
So
and I think when you look at a buyout and a platform business, you're actually building businesses, which is very different.
Sure. So I can give everyone an introduction on Iron Pillar. We are a growth stage and a late stage venture capital fund. We invest typically, our first check is about $15 million and we add across different pools of capital to about $50 million. So we are a traditional, venture capital fund. We take minority stakes. But to sort of weave into to Amit's point as well, at some point, cap tables need to be cleaned up. And there's several investors, market is mature downstream where you have significant larger funds and sovereigns and pensions, etc. But at some point, older shareholders need an exit, promoter wants liquidity, business goes to a certain size whereby people are like, this could be rolled up into something much larger, so which probably gives a lot of opportunities to other folks on the panel. But maybe I can move into what interests us because, technology is obviously something that the larger firms are looking at. When you look at larger businesses, they grow at a certain percentage rate, but obviously technology companies grow significantly faster, which is why you're seeing the sort of global funds as well deploying capital into technology. And obviously, we've seen this change happen, because of COVID. People have, interacted with technology businesses in a very, very different way. We were forced to transact online, whether it was financial services, retail, agriculture, e-commerce, etc. So that's definitely one theme that is very, very interesting, right? Digitization of services. The other theme, obviously, for us particularly, when we talk about what's interesting, is built in India for the world. We saw that, in the 80s and 90s with the emergence of the IT giants. We personally believe that there'll be a lot of value which will get created by Indian companies, and we talked a bit about good talent in India. So we will find that there'll be a lot of interesting entrepreneurs that will build businesses in India for the world. One of them is a very, very large, successful company in the US called Zscaler. It's a $40 billion market cap company. The founder had one vision. He wanted the whole back end of the business to be in India and just the front end in the US. So obviously, things like, dollar denominated revenue, large customers, you get the whole arbitrage of Indian cost base is also a very, very interesting theme. So, and obviously going forward, these businesses will mature and have listing possibilities at NASDAQ as well.
Sure. I think technology is clearly an important factor, right? And I think when you look at most buyouts and larger businesses, clearly our technology, I mean, we were just talking earlier, you look at a buyout of software services businesses and a whole host of other opportunities. So clearly technology is going to be a big driver. What I was trying to get to was between minority investing versus majority investing. And where do you see that to be an opportunity? And is that something that would grow?
Oh, absolutely. So there's a fund called Thoma Bravo in the US, done significantly well, and they've focused on software companies and software that they create. You have Vista Equity Partners that focuses on the same as well, and these are typically investors that are control investors. They go out and work with the promoter. They clean up the old cap table. They add a lot of systems and processes that have worked very well for them in their portfolio. So people are graduating into those kinds of deals. We are a earlier investor, so typically you don't have the size of checkbook to do a control deal. But over a period of time, definitely investors find a lot of comfort in actually controlling a lot of where the company goes by having a majority stake.
Dinesh, if I may just add one quick comment on this minority versus majority. This is a very clinical or a transactional way to kind of think about it. But if you just step back, I think where the industry is, and hopefully it's maturing even further, is the fundamental difference is private equity or venture capital is value-added capital. A lot of people ask me that, with public markets, would your kind of business dry up or would the pipeline look now? Maybe in short term, yes. But structurally, as long as as a founder, management team, promoter genuinely recognizes the value add which a private equity or venture capital will bring, I think then the stake is a secondary conversation. Now, what's the best way to bring that value add, right? If the biggest value add is to get a global management team, maybe control is a better stake because, that gives talent that confidence, right? If it is more strategic, more M&A, one particular lever to play, maybe people can do it with strategic minority stake. So I think as an individual or as an industry, I don't think we should be hung upon what's the stake. I think the real question to ask is be kind of honest to the promise of being value-added capital, and whatever is the form of stake which lets you deliver that value-added to that portfolio company should determine what stake you acquire.
No, absolutely. I think, Harsh, if I can, I just wanted to come to you in terms of one, you have seen for the past decade, worked with almost everybody on this floor, right? And you have seen businesses, the change that has taken place from majority to minority to tech investments to platforms. If you were to talk about some of the fundamental changes that you have seen in the way deals are happening, or essentially the lessons to take away from that, what would that be?
So I think this is a reflection of what Amit and Nikhil have just said, which is that there's generally been a shift to buyouts in terms of dollars deployed. And deal terms have roughly gone along with that, although they always trail. So we've seen a standardization of deal terms, which earlier used to get debated a lot. There have also been new kinds of tools, instruments, capabilities, which have come in partly through regulation, whether it's in the capital markets, it's yielding type of investments, bankruptcy reform. So the regulatory framework is kind of kept up, but it's by definition a trailing factor. Does it it'll have to continue to keep pace with the change. I would still say there's an element of what we do. I mean, there are some prolific deal makers here on the panel. There's an element of what we do that should not feel like rocket science, but ends up feeling like it. I mean, it suits us as lawyers, obviously, and that's what we tell our clients. I think as the market matures more, for instance, it should not be rocket science to do a take private. It's a very standard, common types of transaction that happens in other markets. And I think it requires a little bit of a shift that private equity actually, or acquirers in those kinds of transactions, actually deepen the market. It should not be seen as taking away a listed company. But by and large, the framework has kept pace. It's a trailing indicator. So wherever the other people on this panel go, the law generally follows.
Yeah. You talked about take private, and I think I just want to bring in one perspective and just get your views. Essentially is that the markets have been pretty buoyant over the last few years. What impact does that have on the private equity deal doing perspective there, and how correlated is that? Anybody?
Maybe I'll start. I think that's what I was alluding to. If you think about it, maybe in the short term one could argue negative correlation, right? But I think again, going back to your point, if we truly believe the markets are mature, this is a place where they feed off each other, right? How, the fact that, if to Sudhir's point, if exit is any concern, and if you're operating in buoyant public markets, as private investors, we get visibility on liquidity events, right? That where will we divest, right? I mean, last year is a great example. The most kind of robust private equity market with $70+ billion, and I think one of the most buoyant public markets when it comes to IPO. So they do coexist, right? On the other hand, I think when the promoters see some great examples of private equity-backed IPOs, the way they were received, the way their preparedness were, both in terms of the governance and more importantly, the core of the business model, I think it feeds into the private equity market in terms of the sourcing of the deal, etc. So I think they kind of coexist, and in my view, there's positive correlation than negative.
Just to correct Amit, so I never said that. Neither am I pessimistic, nor am I saying that exits don't happen. What I meant to say in the beginning was to Dinesh's question on how do LPs perceive India, and I was saying that there is still a lot of LP population out there which needs to still cross the hump as far as India is concerned, and we do have it. There is a significant momentum that we have been able to say, but we still need to do a great job of selling India. I think that is probably a little bit more incumbent on funds like us which are raising money for the domestic investment. But that's not to say there is a huge market, and that's been there for a long time to come. It's not that it has happened in the last 3 years. Some of us have been managing funds for over 15 years, and we have delivered exits across cycles, done full fund exits, and so on and so forth. But that doesn't take away the fact that it is kind of given for many of the LPs in the world, and there is a lot of, while there are many of them participating in the Indian market, but there are several who are not yet doing that. The second point on correlation, as far as Dinesh, the fact is very valid that it feeds off each other, and it is a good exit environment that allows you, and each of those, there is no need to segregate buyouts or early stage, etc. Because only when somebody takes out and buyouts does the earlier stage of investors make money, and that's how they raise more capital. So this entire chain has to grow, and if any one of those elements break, then you will find it impacting the other end of the chain as well. So, and in terms of dollar billion, it will always be true that buyouts will be much larger than the earlier stages, because by you're kind of taking a more mature company, you're cleaning up the cap table, you're providing exit to a whole lot of other investors. So it is but natural, but the impact that can be created by the growth investment is still far higher in terms of the fact that you're spurring a whole set of new companies and making that thing. But frankly, I don't see capital markets, what we used to speak about 15 years, that capital markets is a threat for private equity, that a promoter given a choice will first go to the capital market rather than raise money from private equity. That has changed completely. Today, if you look at most of the IPOs, even the minority situations that happen, most of the IPOs have been invested by private equity earlier. So to that extent, private equity is today the first port of call, and many companies which would want to go public would say that I want to raise a couple of rounds of private equity capital. Ready myself for a
that there's a secondary exit by the private equity firm to another private equity firm. And then the other kind of secondary is where the entire private, so there are two kinds of, again, within the second piece there are GP-led restructurings where they restructure their entire fund and sell off their portfolio to another private equity firm or to a secondary buyer who believes that there is value on the table. And then there are LPs who sell their stake in the fund as a secondary stake to another LP where they need to exit for either strategic reasons or liquidity reasons or any other such reason. So I think what Amit was alluding to, the secondary of where one investor, where one PE firm was selling their asset to another PE firm was a little bit, it had a little bit of stigma where people said, you know what, maybe you're just changing hands, there is not too much of value, who knows what the value is. That definitely is changing. And I think that is now changing because 20 years ago there was no VC sort of segment was non-existent. The buyout segment, there was probably one or two players in the market who were doing buyouts, and therefore the entire segment was just growth equity across and lower mid-market where the most of the fund managers were $100 to $300 million sizes. That has changed. Okay, I'll just finish my point. So I think that has changed 100%. There is an ecosystem which is built up, and now that ecosystem is just developing for secondary exits of the second kind, where either GPs are restructuring their entire fund because they believe that it is easier and their effort is better focused on doing something else and someone else can manage the portfolio better. And then secondly, LPs are saying, you know what, we've been invested here for too long, we want an exit now for different reasons, and therefore that entire segment is now developing. And I think that again will grow and that will bring more liquidity into the system for LPs, which will again bring LPs back into the market saying, okay, we invested, let's say X dollars over the last 10 years, now we've gotten X plus back, and therefore let us now recycle this capital back into India, into the private equity sector.
Great, absolutely. I think it's been a great discussion, but I think we've run short of time, which is there. And I think I was completely blindsided with the positioning of the timer there because you can't actually see the time there. I think maybe we need to change the position of the timer there.
Yes, sir, we will. But even if you miss that, you can't miss me.
I think that's no excuse, but I think we've had an exciting discussion. I think if just a quick word, I mean, if we were to have this topic next year, should this be 100 billion or should it be 150 or 200? I mean, are we underestimating the potential? Yes, no.
Maybe I can take that. I think one thing everyone must appreciate is that, you know, investors are in the business of making money. So you actually, if you're investing $100 billion, all of us have, you know, call it 25, 20. I'm not saying this matter of scale, but everyone has a certain IRR threshold they need to deliver. So does Neha, right? So when you talk about $100 billion coming in over a 5 or 10 year period, that money has to significantly multiply. So that is a big question. So certain fund managers don't raise very, very large funds because you have to have the ability to deploy the capital, return the capital back.
Great. I think we're just running short of time. Just a quick response will be.
No, I think if you look at our P to GDP ratio, it's still, you know, kind of subpar when you compare to Western markets. So 100 billion should happen. Now, when and how, you know, it's too difficult to put a timeline, but it'll definitely happen sooner than later. And I think the $500 billion exit will follow.
It's cautiously optimistic as always.
Yeah. No, same here. I think we don't know when, but definitely in the next 3 years.
very, very soon, Dinesh. Unless we hit some self goals like we are as a country, we are never, it's not very difficult for us to do. But given the normal circumstance, I think there's a lot of stars that are aligned for us. 100 billion will happen much sooner than what any of us anticipate. And why? These are just numbers. I think the fact that that as an economy we will do very well and attract a lot more capital.
The last word from the lawyer.
As the lawyer, of course, I'm the most qualified to talk about the numbers. No, I think Sudhir summed it up well, which is these are just numbers, but I think the trends are here to stay, and the numbers will simply be on those lines.
Thank you very much. That was an excellent discussion. Thank you very much for your time. Thank you.